Investing in Vanguard ETFs can be a smart move, but what many people don't know is which one to pick. I mean, you have to consider diversification, dividend yields, your level of risk, and everything else in between. So in this video, I'm gonna break down the top 5 Vanguard ETFs and help you figure out which ones might be best for you. First up is VOO, the Vanguard S&P 500 ETF, one of the most popular ETFs available today. Its strategy is simple. It tracks the S&P 500 index, which represents the 500 largest companies in the United States. Historically, this index has outperformed even the best traders. For example, in the last 10 years, only around 27% of actively managed funds managed to beat the S&P 500. Unlike funds that focus on a specific sector, VOO covers the 500 largest US companies, which spans across multiple industries and offers much more diversification than if you were owning just a few individual stocks. If one company underperforms, there are 499 others to help make up the difference. Similarly, if one sector struggles, the fund's diversified nature allows the opportunity for other sectors to help balance it out. However, broader diversification does mean that there's slightly less potential for growth compared to more aggressive growth or sector-focused funds. For investors seeking a bit more diversification, the Vanguard Total Stock Market Index Fund ETF, more commonly known as VTI, is a great option. VTI aims to track the performance of the crisp US Total Market Index, which encompasses all the stocks in the US stock market. By this I mean it includes all the large, mid, and small cap companies, so over 3,600 stocks in total, giving you much more exposure to the market as a whole compared to VOO. Comparing the two ETFs side by side, they are very similar. Both are holding a nice chunk in the tech sector, with VOO holding around 32% and VTI at around 35%. Both have a decent amount of holdings in consumer discretionary, financials, healthcare, and industrials. Even when you compare their top 10 holdings, there's only a small difference, as both feature the same companies in similar proportions like Microsoft, Amazon, and Google. Now, if you had invested $10,000 in either VOO or VTI 10 years ago, your investment would now be worth over $30,000 with over 200% in gains. Both ETFs also have really low expense ratios of 0.03%, meaning you'd pay just $3 for every $10,000 that you have invested. To keep it simple, both are great choices for anyone looking to build a stable and secure foundation for their portfolio. But if you're willing to take on a little bit more risk for the probability of more growth, this next ETF might be one to look into. Next, we have VUG, which is the Vanguard Growth Index Fund. As the name suggests, this ETF is designed for those who are seeking more exposure to growth stocks. This fund seeks to track the performance of the crisp US Large Cap Growth Index, so it's only invested in the growth stocks of large cap companies. 59% of VUG is allocated to the tech sector, which probably isn't that big of a surprise. Tech companies are always attracted to those that are looking for growth, as they're highly scalable and generally have low overhead and operating costs compared to those companies in more traditional sectors. This ETF has around 179 stocks, with its primary holdings in companies like Apple, Nvidia, Microsoft, Google, Tesla, and others. Alongside tech, the next largest sectors of this fund is composed of consumer discretionary, industrials, and healthcare. This fund also pays out dividends, but the dividend yield is only 0.48%, so nothing really special here. VUG has been around since 2004, and over the last 10 years, this fund has had an average return of over 15%. So if you had invested $10,000 in VUG 10 years ago, your investment would be worth more than $40,000 today, which represents a total return of over 330%. And with an expense ratio of just 0.04%, this fund would be costing you $4 for every $10,000 that you have invested. Now, since this fund gives you more exposure to some of the same growth stocks that you find in VOO and VTI, if you plan on owning both of these ETFs, be sure to take in consideration the overlap of stocks between the two, especially when you consider some of these big names in their top 10 holdings. But what if you're someone that's looking for more opportunity in one of the largest growing sectors, embracing both higher risk but higher reward. If that's the case, you'll want to hear about this next one. When it comes to investing, risk and diversification are closely connected. Generally speaking, the more diversified you are, the lower your risk, but also the lower for your potential reward. On the other hand, the less diversified you are, the higher your risk, but that also comes with the potential for greater rewards. Here's why. If you're 100% invested in a single industry, you'll capture all the gains of its growth. But if it collapses, you'll bear the full brunt of the loss. This is where VGT, the Vanguard Information Technology ETF, comes in. Unlike the more diversified ETFs, VGT focuses exclusively on the information technology sector, offering zero significant exposure to any other industry, meaning it's not a diversified fund. The fund's holdings are concentrated in a handful of sectors within technology, like semiconductors, systems software, technology hardware, and application software. VGT has around 316 stocks, and some of the fund's top holdings are comprised of familiar companies like Apple, Nvidia, Microsoft, Broadcom, AMD, Adobe, and others. Now, for the exciting part, if you had invested $10,000 in this fund 10 years ago, it'd now be worth over $60,000, a massive return on investment. That's an annual average return of around 20%. As for the cost, the expense ratio for VGT is 0.10%, which means this fund would be costing you $10 for every $10,000 that's invested. A little bit higher here than the others, but it's still a low-cost fund. I'd say this fund is likely for those with a stronger appetite for risk, and considering how focused it is in one sector, it would be better suited in a portfolio that has exposure to other industries and sectors. Now, if you're the type that likes more balance, stability, and the added benefit of income, you might prefer dividends, like the fund that I'm about to discuss next. This next one, VYN, Vanguard High Dividend Yield Index Fund ETF, is a nice choice for those looking for stability and consistent dividend growth. This fund tracks the performance of the FTSE High Dividend Yield Index, which includes companies with relatively high forecasted dividend yields. Unlike some of the earlier ETFs that have more concentration in growth and technology, VYM is a tilt towards value and blue chip dividend stocks. As a result, VYM tends to offer less volatility, which can make it an ideal choice for someone who wants more protection of their capital, looking for income, or to live off their dividends from their investment. The fund's holdings are well diversified across various industries, including financials, energy, healthcare, industrials, technology, consumer staples, and consumer discretionary. VYM contains a total of 533 stocks, which you won't find too large amounts invested in one major company, with its top holding in companies like Broadcom, JP Morgan Chase, ExxonMobil, and Walmart. Another point to consider with this fund is when it comes to dividends. And dividends are just payments which are made to shareholders that are shared from the company's profit. VYM offers a dividend yield of 2.6%, which is pretty decent, and it's one of the highest on this list. On top of that, it's seen 13 years of consistent dividend growth. Despite its focus on stability, VYM also sees a healthy amount of growth. If you had invested $10,000 in this fund 10 years ago, it would have more than doubled in value, with an annual average return of 9.7%. And when it comes to the cost, this fund has an expense ratio of 0.06%, so every $10,000 that you have invested would be costing you $6. When it comes to investing, having a diversified and balanced portfolio is crucial, especially when it comes to weathering the downturns. And speaking of diversifying, that brings me to another ETF on this list. This next fund is VXUS, or the Vanguard Total International Stock ETF. And this is one that doesn't just focus on the US market, it spans from markets all around the world. It does this by tracking the performance of the FTSE Global All Cap Index, which covers large, mid, and small cap stocks in developed and emerging markets globally. So specifically companies outside of the US. When broken down by region, this fund has Europe at 38%, as well as a large portion of holdings in emerging markets at 27% and Pacific at 25%. This ETF contains a total of 8,533 stocks, with its top holdings in Taiwan Semiconductor, Tencent Holdings, ASML, Nestle, and a few others listed. As for the cost, this is another low-cost fund with an expense ratio of just 0.06%. This ETF, like the others, also pays out dividends, and it has a dividend yield of 3.3%. And if you had invested $10,000 in this ETF 10 years ago, it'll be worth around $16,000 today. Not the greatest compared to some of the other ETFs that we have on this list. But that's besides the point, as the purpose of an ETF like VXUS is for the exposure to international markets outside of the US market, allowing you to further diversify your portfolio more. There isn't a one-size-fits-all approach to choosing an ETF or when it comes to investing as a whole. These are all solid ETFs, but at the end of the day, what works for you best will depend on your age, risk tolerance, your financial goals, and most importantly, what you're most comfortable with. And if you got some value from this video, be sure to hit that like button and subscribe to the channel to see more videos like this. Thanks for watching, and I'll see you in the next one.